Our third component when looking at the general deduction formula, the positive test specifically, is actually incurred. Again, we've got no definition in the Act, so that means we are definitely going to have some court cases to think about. The first thing that you should take note of is that when we say actually incurred, we are not meaning actually paid. In other words, a taxpayer can deduct amounts that have been actually paid, where the cash has flown, but it's not only those amounts that can be claimed as a tax deduction. Actually incurred also includes amounts that are still owing. So, for example, if you buy trading stock on credit and you are going to pay your supplier in 2 months' time, you will still be able to claim that expense as a deduction because it has been actually incurred. You have the liability to pay. So the crux of actually incurred lies in the following two words: unconditional liability. The moment that a taxpayer has got an unconditional liability to pay an amount, that amount will be regarded as actually incurred. Something else to think about if we talk about actually incurred does not mean necessarily incurred. In other words, it's not about what is necessary for your business. You and I can both run a cupcake business, and I can decide to spend 10,000 Rand on buying gold cupcake holders, and you can decide that no, you'd rather just use plain white ones and pay less. Necessarily incurred is not the issue. It is whether or not something has been actually incurred. And the court cases we're going to use over here is firstly NASPAS or Nationale Pas, and the principle here is that actually incurred means that there is an unconditional liability. So before an expense can be deducted, it must be unconditional. It can't be contingent on a future event. Right, the moment that it's contingent on the happening of a future event, it's not unconditional, which means it won't be deductible. Edgar's Stores essentially has the same principle in the sense that actually incurred means that there needs to be an unconditional liability. But what makes it different from the Nationale Pas court case is that you need to distinguish between the liability itself being conditional, which was the case for Nationale Pas, or the amount being uncertain. So if the liability is unconditional, right? So we know that we are going to have to pay this, but we're not yet sure what the amount is. So the amount can't yet be quantified. Then, because there is an unconditional liability, we can claim an estimate. So we must estimate the amount of the expenditure, and that is what we will be claiming. So one of the sections that you'll still be learning about in future tax years is section 24M, which places a limitation on what type or how much you can deduct in the case of unquantifiable amounts, right? So if I can give you any advice, take a pretty good look at these two and make sure you understand what the difference between them are. Our third court case for actually incurred is golden dumps, okay? And the principle here is that if there is a disputed claim, in other words, if something goes to court, for example, you cannot claim a deduction if the outcome of the dispute is undetermined at the end of the year. So if we get into a fight and you sue me and we go to court, and at the end of the year of assessment, I might be able, or you might be able to sue me for damages, but the dispute is not yet clear, it's not yet determined. That means that there's no unconditional liability, and that means that there's no deduction available. So if you've got a disputed claim, you can only claim if the outcome of the dispute has been determined at the end of the tax year. Our last principle, or court case and principle for actually incurred, lies with Labat. And the thing with Labat was that there was a company that issued shares in exchange for expenditure that it paid. And what the court said here was that actually incurred means either expenditure for which a liability has been incurred, or the action of spending funds, so a diminishing in the value of your assets. And because for the issuing of shares, if you think about the journal entry behind the issuing of shares, it does not reduce the assets of a company, and therefore if a company issues shares as payment for a service, for example, or to acquire an asset, that is not necessarily going to be seen as actually incurred. However, a bit later in your tax academic years, so specifically your fourth and final year, if you're planning to go on to advanced tax or PGCA, you will learn about section 40CA, which is all about but what happens if a company does issue shares as payment for services. Okay, because we've got a special rule for that. For our purposes, we know that the issuing of shares does not mean that an amount has been actually incurred, because there's no liability that was incurred, and there is also there's no spending of funds.